If you're walking into the 2026 housing market with a $500,000 budget, you're likely expecting a dream home. You've crunched the numbers, you've got your pre-approval letter, and you're ready to stop renting. But I'm here to tell you the truth, the cold, hard, unvarnished reality. In today's market, $500K, then the forever home ticket. It was 5 years ago. It's a battlefield. You're up against institutional investors, shifting interest rates, and the housing supply that refuses to stabilize. If you go into this without a surgical strategy, you aren't just buying a house, you're buying a liability that could tether your finances for the next 3 decades. Today, we're cutting through the noise. No fluff, no real estate agent jargon, just the raw math of buying a $500,000 property in 2026, and exactly how you avoid losing your shirt. Let's dive in. First, let's address the elephant in the room: interest rates. We are currently living in a cycle where 6.5% to 7% mortgage rates are the new normal. Gone are the days of the 3% pandemic-era stimulus boom. When you buy a $500,000 home today, your monthly payment isn't just the sticker price divided by 360 months. With current rates, you're looking at a petty principal, interest, taxes, and insurance that can easily push your monthly nut above $4,000, depending on your local tax rate. But here is the harsh reality. Number 1. The $500,000 house of 2026 isn't the same as the $500,000 house of 2021. In many suburban markets, this price point has shifted from turnkey luxury to entry-level fixer-upper. If you are looking at a pristine 2,500 square foot home for $500,000 in a major metro area, ask yourself, what is wrong with it? Is it the zoning? Is it the floodplain? Is it the massive HOA special assessment coming down the pipe? In 2026, the market is bifurcated. There is the top-tier luxury market, which is relatively insulated, and then there is the $400,000, $600,000 bracket, which is the most competitive zone in the country. You are competing against first-time buyers who are desperate and professional flippers who have cash on hand. If you're playing by the old rules, you've already lost. Most buyers focus on the closing costs, those 2% to 5% that you pay to the title company and lender. But that's the amateur hour. Let's talk about the invisible debt. When you buy a property for $500,000, you need to apply the 1% rule of maintenance. That's $5,000 a year, minimum, for repairs. New roof, that's $15,000. HVAC unit goes down in mid-July. That's $8,000. In 2026, the cost of skilled labor has climbed by nearly 20% compared to 3 years ago. Then, there's insurance. If you think you're just paying for the structure, you haven't looked at the climate risk premiums lately. In many states, insurance companies are fleeing high-risk areas, leaving only expensive surplus lines of insurance that can cost you double what you budgeted. I've seen buyers get approved for a $500,000 loan and think, I can afford the monthly payment, but they failed to calculate the total cost of ownership. A $500,000 house is not just a mortgage, it's a living, breathing machine that demands to be fed money every single month. If your household income is less than $130,000 per year, a $500,000 home, this rate environment, is not an asset, it is a financial anchor. You've heard the cliche, marry the house, date the rate. It sounds smart, right? It implies that you should buy the house you love now and just refinance when rates drop. But this advice is dangerous if you don't understand the equity trap. What if rates don't drop to 4%? What if they stay at 6% for the next 5 years? If you bought that house expecting a refinance that never happens, you are trapped in a high payment cycle. Furthermore, you need to understand the appraisal gap. In 2026, lenders are becoming hyper-conservative. They are scared of the potential correction in the suburban market. If you offer $500,000, but the appraiser says the home is only worth $475,000, you are responsible for that $25,000 gap in cash. Do you have $25,000 sitting in your savings account on top of your down payment. If not, you're not buying that house, period. Successful buyers in 2026 are not emotional shoppers. They are data analysts. They look at the days on market.com for comparable sales. If a house has been sitting for 45 days, that is your leverage. Don't fall in love with the wallpaper. Fall in love with the deal. So, how do you navigate this? Here is your 2026 survival blueprint, the local lender test. Don't use a massive, nameless internet bank. Use a local mortgage broker who understands the specific nuances of your county. They know which properties have tax issues or upcoming special assessments. The inspection contingency. In the madness of previous years, people were waiving inspections. Do not do that. In 2026, a $500,000 house can have $50,000 worth of foundation issues that aren't visible to the naked eye. Pay the $500 for a structural engineer if you have to. It's the cheapest insurance policy you'll ever buy. The 20% rule. Aim for a 20% down. If you can't hit 20%, you are paying private mortgage insurance (PMI), which just adds to your monthly waste. If you can't afford 20%, consider if you are truly ready for the responsibility of home ownership. Neighborhood stalking. Visit the neighborhood at 10 p.m. on a Friday. Is it quiet? Are there cars blocking driveways? The best house in a declining neighborhood is a bad investment. Calculate your walk-away price. Decide on your maximum price before you enter the open house. If the bidding war goes $1 above that number, walk away. There is always another house. Your ego is not worth $50,000. Buying a home for $500,000 in 2026 is a significant milestone, but it shouldn't be the moment you lose your financial freedom. It requires preparation, a cold eye for numbers, and the willingness to walk away when the math doesn't work. If you found this breakdown helpful, hit that subscribe button. We release deep dives like this every week to help you win in this complicated economy. If you want my personal checklist for evaluating a property's true cost of ownership, drop a comment below saying checklist, and I'll get it over to you. What's the market looking like in your area? Are you seeing prices cool down, or is it still a bloodbath? Let's talk about it in the comments. Thanks for watching, and stay smart with your money.